So careers in finance. Okay, very good, very good. So almost everybody has answered. Okay. So largely, when we talk about finance, finance is basically a discipline which is concerned with four major pillars of organization. What are those? One is acquisition of funds. Second, allocation of funds. Then utilization of funds. And finally, the management of funds or regulation of funds.
Just a moment, sir. Just a moment. Yeah. Sorry.
Yes,
yeah.
sir.
Sorry to interrupt. All the students are advised to take notes because let us try and understand there are multiple answers that you can get from this session for your interviews. So if you are thinking this is just a plain session, it is not. There will be many answers that you will be getting for the same questions that will be asked in interviews. Maybe a question like what is finance? So I'm making you understand the importance of this session. So make sure everyone is making notes, self notes, and then we'll share it in the group as well. Yeah. Sorry to interrupt. Yeah, over to you.
Okay.
Sir.
Thank
Yeah,
you. Thank you so much, Mayuj. So guys, largely the finance is basically when we talk about the finance field, okay, it revolves around the four aspects. One is the allocation of funds. Okay, sorry, acquisition of funds. So acquisition of funds in the sense, as a finance manager, okay, or if you are working in any company, if you're dealing with the money, our natural choice is that we want to get the fund which are with the cheapest one. So how do you decide which funds are cheaper and which funds are relatively costlier? Okay, so it depends upon the cost of capital. So we call it as in cost of capital. So now when we talk about capital, okay, capital is the amount of money which we invest into the business. So this capital can be from, okay, borrowers, that is owner's fund. So if it is an owner's fund, we largely refer it as a capital, or we call it as an equity. Okay, and if it is a borrowers, so then we call it as an basically loans, or we call it as a borrowings. So there are two sources from which we get the fund. Now each source has its own cost. For example, if you raise the funds through equity, you have to pay the dividends. So dividend is the cost of capital associated with equity. But if you borrow the funds, naturally you have to pay the interest on this. So interest is the additional cost which a borrower has to pay. Okay, so now in this case, as a manager or as a finance person, I have to understand if my need is of 50,000 rupees or the 50 lakh rupees, what should be the source of funds? So that source of fund we need to find out. Yeah, right. Very good, Nikhil. So Nikhil, basically CAPM that we are going to discuss further, that is capital assets pricing model. It basically talks about how to calculate, okay, return of the risky assets. That we are going to see it in the portfolio management capital assets pricing model. That is we are going to discuss in the further slides. Okay, but for the time being, I'm just trying to understand. Let's say, how do you acquire the funds? So as a manager, our job is to acquire the fund in such a way that we need to make the combination of both equity and cost, that is borrowed funds, that is debt funds, in such a way that the effective cost of capital should be minimal. When I'm saying the combination, the reason being is, now if you talk about equity, on equity you have to pay the dividends. Okay, now who invests the equity? So the equity can be the owner's equity, that is the promoters, or apart from the promoters, there may be some other investors which are investing into the business. Now, just think from the investor's point of view. Why they should invest in your company? If they have the options like say fixed deposits, if they have the options like say gold, if they have the options like say investing in real estate, why they should invest in your company? So they're investing in company because they are expecting a risk premium. So what is that risk premium? Yes, Nikhil, I'm going to the CAPM. Okay, very good. So they're expecting the risk premium. So what is the risk premium? Suppose if I invest in the equity, so if I invest in the fixed deposits, okay, and if I'm getting say 6 to 7% return, so this is called as a risk-free return. That is called as a RF, risk-free return. Okay, I'm not taking any risk. I'm just investing into the fixed deposits, and at the end of the year, I'm getting 6 to 7% return on this. So that is RF, risk-free return. But instead of investing in FD, if I'm investing in your company, okay, naturally, my expectations are much more higher. I'm not going to settle at 7% because I'm taking risk, because there is no fixed income from the equity. The dividends can change. So I'm expecting, if I'm taking investing in the equity, I'm expecting at least, say, for example, 12% rate. So now the amount or the rate, the interest which an investor is expecting, which is over and above the risk-free return, is called as a risk premium. It is called as a risk premium. So in this case, suppose risk-free return is 6% and investor is expecting 12%, risk premium is 6%. I'm investing in equity because I'm expecting 6% return more as compared to risk-free return. Now just imagine, this is the expectation of the investor. Now, as a company, now you have to ensure that if I am taking investment from the equity holders, I need to earn at least 12% return, then that will be at no profit and no loss, because whatever profit I'm earning, that will be given back to the equity shareholders. But in this way, whether the company will work? No. They have to ensure that their effective cost of capital, the rate of return or the return on investment should be more than this 12%. So how, suppose if they earn 18% on whatever capital they are employed. So by getting 18% return, so if they, even if they pay 12% back to the investors, they will return 6% as the return on investment. But as compared to equity, yes, borrowers, that is debt funds, are relatively cheaper. So how much it costs? Suppose generally the debt funds cost around 8 to 10%. If your credit ratings are good, if you go to international market, even this cost even further can be brought down. It goes up to 4 to 5%. So it means that debt funds are relatively cheaper as compared to equity, but there is an inherent risk associated with the debt funds. So what is that inherent risk? So that inherent risk is debt funds comes with the compulsory repayment obligation. Compulsory repayment obligation. What does it mean? So it means that suppose if I take loan from the bank, even if I don't make the profits instantly or immediately, I have to repay the EMIs or the interest and principal amount from the next month itself. But if my company is a startup company, okay, just imagine a situation, and I'm expecting my profits are going to be earned, say, after 3 years or 4 years down the line. So am I in a position to repay the principal or the loan amount immediately? No. So in that case, even though it is cheaper, okay, and even though equity capitals are costlier, we need to make a balance of these both too. Reason being is equity doesn't come with the compulsory repayment obligation. Compulsory repayment obligation, it means if the company doesn't make any profit, they don't have to pay the dividend to the equity shareholder. These dividends, if it is preference, can be carried forward to the next year. Suppose in a year, our company, suppose in a particular year, the company has not made a single rupee of profit, then they don't have to pay anything to the equity shareholders because they are the owners and they get profit only when the company makes profit. Okay, so as a manager, we have to find out, let's say, what should be the combination of both equity and debt, so that the effective cost of capital, it should not be 12%, it should not be 8 to 10%, but it should be in between. So in between, say, for example, if I'm able to manage it around 7 to 8%, so that is an effective cost of capital. So what I do is, if I require 50,000 for the time being, just a hypothetical example, suppose if I say borrow funds through equity 20,000 and 30,000 through debt. And this concept is called as a trading on equity. This concept is called as a trading on equity. So what is trading on equity? So when we are keeping a combination of both debt and equity in such a way that the effective cost of capital remains say at a lesser side, that is called the trading equity. So it means that here, when we talk about acquisition of funds, we need to deal with the trading on equity. What should be the combination of debt and equity? Then after that, next aspect is allocation of funds. So what is allocation? So once you acquired the fund, now it is your responsibility. Now it's your job that whatever funds you are acquired, okay, those funds need to be invested in such a way that the return on investment should be more than the effective cost of capital. If I'm running a business, naturally, my motive is to earn the profit. Okay, I cannot settle. Suppose if my effective cost of capital is 8%, and return on investment is 10%, so my return on investment is only 2%, because out of 10%, I have to repay 8%. But am I here to earn 2%? No. Okay, because if I'm starting the business, I'm expecting that the business should generate more profit as compared to the risk-free job. Suppose I would have employed somewhere, if I would have employed by someone else. If he is paying, say, 1 lakh rupees salary per month to me, So I'm expecting that instead of doing that regular job, if I'm getting into the business, my earning should be more than 1 lakh rupees. Then and then only I'm interested to continue in the business. So naturally, I'm not going to settle it here at 2%. So what I'm expecting is that the next task is whatever funds we have earned, that fund, raise, that fund should be utilized in such a way that the rate of interest or earning should be much more than the effective cost of wealth. So this talks about allocation. Okay. Now the third aspect is management. So this allocation can be into different assets. For example, this money can be used to buy the machinery, to expand the business, to buy the goods, okay? Or even if I have the spare money, so I can invest it somewhere in the short-term securities. So that is what the allocation is. So once the allocation is done, next task is then what is called as then management of fund. So what is management, by the way? So management in the sense, the allocation should be dynamic one. What I mean to see, if it is dynamic, it means that I need to change my allocation as per the market needs. Let me give an example. Suppose if I'm investing my money into the security market. Okay, so while investing, there is a concept called as a portfolio management. We create the portfolio. So what is portfolio? So when I'm investing my money, I don't invest in only one security. So instead of that, I invest in the multiple securities. Say for example, I invested certain amount in real estate, then some certain amount in IT companies, some amount in pharma companies, so that as these three sectors are different, so if anything, there are ups and downs in the market, so those ups and downs cannot directly or equally affect all three sectors. Suppose tomorrow our IT sector is highly depending upon the US law. If anything happens in the US, the sector which worstly affects is the IT sector. Now, suppose if I have an exposure in IT sector, okay, if anything happens there, immediately I should withdraw the fund from IT sector and switch it to the pharmaceutical or real estate. So that is what the allocation is. So allocation need to be dynamic. It need to be changed as per the requirement of the market. Okay, and sorry, that is about the management. So managing the fund effectively. And finally, the repayment option. Like say, when it comes to the funds, we have to ensure that all these funds need to be repaid on time. So this is what the finance is all about. So it talks about finance is basically concerned with the four functions: acquisition, allocation, management, and utilization. I hope you understand this now. Okay. So guys, what we will do is now from this point, what we will do is we'll try to first understand how the finance has been evolved over the years. What are the present scenarios? Okay. And considering those present scenarios, how this is affecting the job opportunities in the market. Okay. So now when we talk about finance from the individual perspective, so as I told you, finance is a science of managing the money, financial resources versus specific objectives. So it basically affects everyone. So for individual's perspective, these four functions can be in the form of saving, investment, retirement, or insurance. Okay. So capital, for business perspective, it could be related to the capital raising, expansion, working capital. Or from the government perspective, it can be in the form of, say, taxation, budgeting, or debt management kind of. Okay. So now these are certain examples which are related with those all four functions. Okay. Now having said this, we'll see the evolution of finance. As I said, the traditional finance used to be revolved around these three functions. One is bookkeeping. As I told you that earlier, when it comes to the finance, we used to think about costing, accounting. Accounting is an art of bookkeeping. Okay. Or preparing the financial statements, costing, taxation. So earlier we used to deal with only these some amount of functions, say for example, bookkeeping, banking, and then lending kind of thing. But nowadays it has been shifted. As I told you, when it comes to the finance, we are not expected to do the accounting work. So what is expected is you should be able to read the financial statement. That is your job. How to prepare the statements, that is the job of the accountant, or that is the job of the auditor, that is the job of the chartered accountants or company secretaries kind of thing. Our job is in modern era, it has been evolved from merely bookkeeping, banking, lending to the modern era in the form of portfolio management. Okay, so beginning in the 20th century, okay, the finance has been evolved in quantitative and in analytical discipline. How? Say, for example, let's take a portfolio theory. So, what a finance manager expected to do in portfolio management? So, when it comes to the portfolio management, we have to just remember that the basic concept behind the portfolio theory is developed by Harry Markowitz. And it was in the year 1952, and it is still relevant in the finance domain. So, what is simply portfolio theory is? The basic principle of portfolio theory is, or the portfolio management is, don't put all eggs in one basket. Just imagine that you are working in one of the asset management company. So, which can be, suppose there is a mutual fund company. So, what is the job of mutual fund company? So, mutual fund companies basically collects the money from the retail investors. Those investors, they don't have the knowledge about the market, or they don't have the time to oversee the regular, say, happenings in the market. So those are called as the passive investors. So what the passive investor does is they invest money in mutual funds. Now what the mutual funds does, they have their asset, they have their mutual fund money. So that is called as an asset under management. They have this is an amount which they have collected from the passive investors. On this asset under management, there is an investment manager, or we call it as a portfolio manager. So what is the job of portfolio manager? So the job of portfolio manager is whatever fund they have collected from the passive investor, he or she has to invest it somewhere. So while investing, he follows a principle called as a portfolio management, and that is called the Markowitz efficient frontier. You must have exposed to it. So what the Markowitz efficient frontier theory says is that we have to balance risk and return in such a way that at a given point of risk, you should be able to get the maximum return. So that is what Markowitz efficient market theory is. No worries. What we will do is eventually we are going to cover one topic that is called as an financial derivatives or capital market. Okay. So in financial derivatives, we are going to do all these things in practical. So we'll get the data from, say, historical data from NSC. Okay. Then we will see how the forward works, future works. Okay. Option works. How to manage the say portfolio. How to calculate the beta of portfolio. And if suppose if there are 10 stocks in my portfolio, which stock should be offloaded so that my overall risk of portfolio should be less. Because suppose if I have say 10 lakh rupees in total investment, if the market goes down, I'm not going to sell all 10 lakh rupees. So what I will do is in this 10 lakh, if suppose if I have 10 stocks, I will find out which stocks are most vulnerable. So how do you find out stock vulnerability? So it can be found with the help of beta calculation. We call it as a beta. So beta measures the riskiness of the stock, how your stocks react with respect to the changes in the stock market. Okay, so accordingly we'll decide like, which stock should be offloaded, which stock should be bought, kind of thing. So in this case, so that we are going to see it in practical. So as a portfolio manager, we are expecting, so what should be the combination? Like, so whatever amount we have, that should be invested in the different sectors so that risk is minimum and profits are maximum. Okay. Only objective here is that maximize return at minimum cost. Then there is one more concept called as a capital asset pricing model. It is also evolving. So what is capital asset pricing? So capital asset pricing model is now this is the model which has got guys. This is very important one. Even though it was framed earlier, but it has got Nobel Prize in economics. Nobel Prize in economics. So there is a simple formula for capital asset pricing model. So what was that formula? So this formula is about calculating the expected return of risky stock. Calculating expected return of risky stocks. So what is that expected return? So how much an investor should expect from investment? Say for example, if I have to invest in say TCS, my expected return would be different. But I'm investing in certain company which is not familiar, with no strong financial background, but I just consider that I have somewhere a gut feeling that this company is going to grow exponentially in future. Naturally, if a company is stable, my expected returns are less. But if I'm taking the higher risk, my expected returns are more. Now, how to calculate the expected return? The simple formula in this case is risk-free rate, that we call it as RF, minus, okay, risk-free rate plus beta, that we have already discussed, multiplied by risk premium. So what is risk premium? So market return, that is RM minus RF. So that expected return, don't worry, as I told you that in capital market, we are going to calculate the beta as well. So this is important while investing. So that's why CAPM has gone the, again, the importance. Now the next aspect is, now we are dealing with the derivatives. Okay, before trying to make you understand about the derivatives, I just want to one question, because this question I generally ask to everyone. Okay, so guys, just imagine that you are a tomato manufacturer, sorry, ketchup manufacturing company. So for ketchup manufacturing company, the raw material is tomato, right? The raw material is tomato. So you can just see that sometimes the tomatoes price are 20 rupees per kg, but sometimes it goes up to 80 rupees per kg. But as a manufacturing company, are they changing the prices of ketchup? Somehow they are able to maintain the prices of ketchup. How they are doing it? Guys, have you understood my question? My question is, just imagine you are running a tomato ketchup manufacturing company, and we are assuming that tomato ketchup is made from tomatoes, not from artificial flavors, okay? So in this case, Nikhil, commodities prices can fluctuate to hedge our risk. Now, how to hedge? That is my question, Nikhil. This is a simple example, right? The tomatoes prices can be 20 rupees kg, 10 rupees kg, but it can be up to 80 rupees kg. How can that mitigate that risk? Okay, anybody has any idea? Nikhil, not futures, okay? Future is the wrong answer. Yes, Deepa? Guys, anybody has any questions? Aditya? It is like a contract thing, okay. What exactly? Aditya, can you please explain a little bit more? How do you ensure that the prices of tomato is not going to affect my price of product? Forward contract, very good. What is forward, Nikhil? Okay, guys, when I ask the same question to my students, okay, generally their answers are, like some of their answers, like say, what the companies can do is, when the prices of tomatoes goes down, they try to say buy it in bulk quantity, okay, and store it somewhere. I have then again I ask the question, like say, is there any other Aditi bond? Okay. When I ask the same question, same that somebody else answers, like say, when the tomatoes prices goes down, the company can do one thing: they can procure the tomatoes in bulk. They can say take the pulp out of that tomato and they can store it somewhere. But in both the situations, just imagine that we want to save cost at one point of time. Even if you buy the tomatoes and store it somewhere, even if you take out the pulp and if you store it somewhere, okay, naturally you are saving money at one point. At the same time, we are investing it somewhere else, because storing itself is a costly affair. We have to create a cold room. Okay, we need to maintain the temperature, and these are the perishable products. Okay. Ashish Gupta. Okay, future. Okay, good. Future is not the right word. Future is not the right word. Okay, I'm coming to that point. Nikhil will buy from you at fixed price. Okay, I'm coming on that, Nikhil. Okay, now guys, just remember, in this case, we are saving at one point, okay, and at other point, we are spending a lot of money to create a cold infrastructure, okay, and then to maintain the temperature kind of thing. And as these are the perishable products, so we don't know, okay, like say when the whatever commodities we are purchasing is going, we don't know how long they are going to last. So this cannot be the solution. So what can be the solution? The solution in this case can be a farmer or the company can go in contract with the farmer. A company can get into contract with the farmer. Now just remember, now these are the two parties which are worrying for the opposite situations. So what is the worry of the farmer? The farmer is worrying that if he is harvesting the tomato, he is worrying that in future the prices of tomato should not go down. If suppose if he is expecting that today's market price is 20 rupees, he is expecting by the time my tomato harvesting period comes in, the market price should be at least 20 rupees so that I will get the reasonable profit. That prices should not go down. At the same time, the company thinks that whatever tomatoes I'm buying, okay, at present the price is 20 rupees. So in future, if I need the tomatoes, this price should not go up. Now, what they do is that companies and farmers can come together. They can make a contract, and but even today, okay, and they get into contract today, okay, with the certain conditions that the company is going to buy the tomatoes at fixed price. So that price may be 20 rupees, 22 rupees, whatever may be the decided price. Okay, this is an informal agreement between the company and farmer. Okay, and what will happen at the end, because if the farmer sows tomato today, it will take 3 months to grow the tomatoes. Okay, mature tomatoes. So after 3 months, that farmer is going to sell to the company at 20 rupees only. So by this, the risk is mitigated by both the parties. Okay, risk is mitigated by both the parties. Here, the farmer did not have to worry about the increasing prices. Decreasing prices, and the company did not have to worry about the increasing prices. So this simple concept, as we are dealing with the tomato, we call it as a forward. These are called as an forwards. Okay, just remove the example of forward and say tomatoes. If you take the example of currencies, suppose if I am importing something or exporting something. So even if I put order today, that order may be delivered after 1 month. Just imagine the defense contracts. The government goes into, say, contract with a different manufacturing company today, and those equipments were supposed to be delivered after 10 years, 15 years down the line. Now, whatever cost which the company is quoting today is as per the dollar and rupee prices today. Whether these prices are going to be constant in future, no. So for that purpose, now in this case, remember, derivatives comes as a handy tool. So basically, derivatives and hedging tool. Derivatives and hedging tool. So in this case, what happens is we decide the price at which in future that commodity is going to be traded. So I can just go to the bank, being an importer or exporter, negotiate the deal. So let's say suppose today's spot quote of USD versus INR is suppose 92.44/92.34 or 55. So one is the bid price, other is the spot price. Okay, so bid is the buying price and second is the selling price. So 94.22 is the buying price, 94.35 is the selling price kind of thing. So I can fix the price as of now. So even if whenever I get the dollars, I can convert it into rupees, or whenever I get the rupees, I can convert it into the fixed dollar price. So that's why derivative is important. Now, these are playing important because the globalization has started. We have to deal with the multiple companies. So we need to specialize people who can mitigate the risk with the help of derivatives. Then it comes to the next aspect, is called as risk management. Now, as a management, okay, as a finance student, you should be also expected to mitigate the risk. So derivative, yes, one of the options. So what kind of risk generally of company the finances are exposed to? So these risks could be in the form of, say, internal risk. Okay, internal risk can be failures, technological background, cyber attacks. Okay, it could be credit risk. Credit risk in the sense, for example, as a bank, just imagine you are lending the funds and you are not sure whether the borrower is going to repay the funds or not. So that is the credit risk. This risk could be because of the market risk. It could be because of the market fluctuation. So every company needs a person who can manage the risk effectively. So nowadays, the job of finance person has changed merely from bookkeeping, accounting, banking, so investing, lending kind of thing. It shifted from that to portfolio management. Then deciding the return on, say risky assets, hedging the funds to risk management. And this has been now supported by a technology called as an artificial intelligence, blockchain, crypto, robo advisory. Okay, that we are going to discuss. Okay, guys, is that okay? Am I going okay? Any questions? Nikhil, very good, very good. So what I will do is that considering the paucity of the time, okay, I have created a comprehensive PPT. I'm going to share it with the Mayur sir. In turn, he will share it in your group. Okay. So I'm not going to discuss more on the theoretical concept. Directly, we'll jump onto the skills which are required and then what job opportunities are available. Okay. But only one thing that you have to remember is before going to say job opportunities, you need to remember that in risk management, you have to remember one concept called as a value at risk. We popularly call it as a VAR. So what is value at risk? That term you need to remember, okay? So value at risk is the common risk measurement tool, okay? And how it is decided? Suppose if you have, your portfolio has a value at risk of 10 lakh rupees at 95 confidence. Okay. So if your portfolio has suppose value at risk of 10 lakh rupees at 95 confidence. So if it is 95 confidence, 95% confidence, it means that there are 5% chances that there will be, your losses will exceed more than 10 lakh. I hope you understand this. Guys, let me give an example, one more example. Suppose you are managing a portfolio of say 1 crore rupees. You are managing a portfolio of 1 crore rupees. Naturally, if I'm managing the portfolio of 1 crore rupees, my portfolio will include investment into different securities. Every security has its own risk component. Going by the present risk, say dynamics, I am expecting that my value at risk is 10 lakh rupees at 95% confidence. 10 lakh rupees at 95 confidence. It means that if anything happens, anything worst happens in the market, I'm going to lose 10 lakh rupees. And how much is the confidence I'm having? I'm having 95% confidence. So I'm 95% sure that anything worse goes wrong. Okay, if anything goes wrong, I'm going to lose 10 lakh rupees on my entire portfolio. So in other words, can we say there are 5% chances that my losses can be more than 5%, more than 10 lakh rupees? Okay, so that 5% is basically, and in this case, 95% is that we call it as a confidence interval, also the confidence, and 5% is called as a value at risk. Guys, I hope you understand this. Perfect. Great. Okay, now moving on. So these are the key participants in financial market: households, businessmen, government, and financial institutions. I'm not going to. So they are well connected and they are driving the global financial system. Okay. Now this is what a major concept is. Why we have included this in today's classes? Okay, that naturally I'm going to take 3-4 more lectures, and almost all lectures are on this topic. We're going to discuss about money market. We're going to discuss about the capital market. We're going to discuss about the forex market, and at the same time, we're going to discuss about the derivative market. Okay. To summarize, what is money market and why, how it is different from capital market, forex market, and derivative market? Okay. So money market and capital market, for the time, we will try to understand the differentiate between these two. So money market is meant for borrowing a short-term finances. Borrowing a short-term finances. Suppose, now who are the participants of money market? So in money market, only those large financial institutions are able to participate. For example, in money market, only central bank, that is RBI, can participate. All commercial banks can participate. Large corporations. So when I say large corporation, what is the definition of large corporation? So definition of large corporation is the companies with very high revenue, very high asset base. Okay, they can only participate in money market. Okay, mutual funds, insurance companies can only participate in money market. So now what is the need of, say, exploring the money market? Just imagine you are a bank. Okay, you are into the bank. Okay, now every bank has to follow certain legal compliances which are laid down by the RBI. Now one of the legal compliances meant compulsory mention of CRR. So what is CRR? CRR stands for cash reserve ratio. CRR stands for cash reserve ratio. So to summarize, what is CRR? If I have to explain it in simple terms, okay. Say for example, if the bank is earning, say, so what is the business model of the bank? So bank take the deposits at lower rate of interest, and they give the loans at higher rate of interest. So difference between these is called as a spread, or we call it as a profit margin. Just imagine a bank has, hypothetical example, suppose they have collected 1,000 rupees as deposits. What will happen, suppose if all 1,000 are given in the form of loan? Naturally, there will be a risk exposure because loan comes with the risk, inherent risk. there is a high possibility that some amount of loan may become NPA eventually, or that can be turned as a bad debts. So the loans which are not going to be recovered by the bank. Okay, so now if the bank deposit say accepts 1,000 rupees deposit, can the entire 1,000 rupees can be given loan to the customers? No, the RBI basically keeps certain say, regulatory parameters. So what does regulatory say? For example, CRR, SLR. Okay, so CRR stands for cash reserve ratio. So now what is cash reserve ratio? Now whatever may be the deposits which the bank has collected, out of that, suppose I don't know the present CRR, but I think it is somewhere around 4.5% something. So if the company has collected 1,000 rupees, out of that 1,000 rupees, they have to compulsory maintain 4.5% in the form of cash. SLR, they have to compulsory maintain in the form of either gold or T-bills. Those are called as the most secured ones. Okay. Now, as per the mandatory requirement, now what is the purpose? The government wants to ensure that if you expose your money more to the lenders, then there is a chances that the inherent risk is higher. So that's why we need to balance it somewhere. So how do we balance it? So we can keep some part into the risk-free assets, that is gold, treasury bonds kind of thing, some part in the form of cash so that emergency or unforeseen contingencies can be met off. Okay, and remaining part can be given as a loan. Okay, now just as per the mandatory requirement, suppose a particular bank has to keep, say, 10 lakh rupees as CRR. That day they fall short of 50,000 rupees. So now if you get into the open market, and suppose if you try to get the 10,000 rupees or 50,000 rupees, that may be a cumbersome task because we have to take the long-term loan. But in this case, this money market is meant for short-term borrowing. So this borrowing can be up to 1 month, 1 day to 1 year, up to less than 1 year, because largely in money market, the maturity period is less than 1 year. So what happens is that for the timing, today if I need only 50,000 rupees, I will borrow it from money market. I fulfill this criteria, and tomorrow I'm going to return it. So it means that here, money market is meant for short-term borrowings. It ensures liquidity, yes, because the duration is less. It has low risk. Reason being is that it has the lesser tenure. The examples of money market are money market instruments are treasury bills. What are treasury bills? These are issued by the government. Okay. And on behalf of government, RBI generally issues this bonds, okay, bills to the banks so that this money can be used by the government for the very development purpose. Now, what are the maturities of these T-bills? So naturally, are 3 months, that is 91 days, 6 months, that is 182 days, and 1 year, that is 364 days. Other instruments can be commercial paper. So commercial papers are basically an unsecured loan, okay, and without any collateral. When the large corporations requires money, they can get the money through commercial papers. Then it could be certificate of deposits. So these are some of the instruments of money market. Now, there the maturity is generally it is less than 1 year. But if I need the money for the long-term purpose, suppose if I'm constructing a plant and it requires 4 years to completely construct the plant. So in that case, I can get into capital market. So it is meant for long-term borrowings. Okay. So long-term borrowing is in the form of equity capitals. Okay. So in debentures. Okay. Debentures can be convertible, non-convertible, bonds. So these are the examples of equity capital. So here the returns are relatively higher because the locking period or the duration is higher. Then another is the forex market. So forex market here we deals with the currency conversion. For example, suppose if I get the direct code, so there are different codes. Suppose tomorrow you went to one of the airport, you want to exchange the currency. So what you will do is you will go to that bank counter kind of thing. Here you can see one code. That code is suppose USD oblique INR is equal to suppose 94.33 oblique 94.56. What does it mean? So that bank is giving this code is called as a direct code. Why direct code? Here I am selling Indian rupees to buy the US dollars. Here I am selling Indian rupees to buy the US dollar. So now what is this rate is called as a bid rate. This rate is called as a bid and this is called as an ask price. So bid means it is buying price and this is selling price. So if bank is buying okay, US dollars, and they in return they will give the INR. So price will be 94.33. So it means that they will buy your dollars, and against $1 they will give you 94.33 rupees. But if they want to sell the dollars, okay, so they will take 94.56 Indian rupees against $1. So the difference between these is the profit. Now, in this case, in forex market, now how do we decide this pricing? So this pricing is decided based on the forex market. Largely, it is related to the currency conversion. So how can you sure, okay, like say for US dollar, I have to pay only 94 rupees or say 100 rupees, whatever may be the price for that matter. So these prices are basically decided in forex market. And last is derivative market. So in derivative market, as I told you, okay, that I have given an example of the earlier example of tomatoes. Tomatoes are for perishable products. So perishable products don't trade on the financial market. Okay, so that's why those comes under forwards. Then, but we can make the contract of non-perishable items. So for example, I can buy the crude oil. Today, suppose if I'm considering that crude oil prices are very less, or particularly commodity, I can buy it. Okay, I want to buy it say after 3 months. I'm expecting that price is going to go higher. What I will do is either sell it at today, so that when the maturity comes, I have already bought it. I will get a fixed price. Okay, or I suppose I'm assuming that the prices of commodities is going to decrease in future. Already I have bought it. So what I will do is I will fix the price at what price I'm going to sell it after 3 months. So whatever may be the prices at that point, I will get the price which is fixed at present point. So this is basically the futures. So if you are dealing with the non-perishable commodities, that comes to the futures. Then here comes the options, then swaps. Remember, basically derivative market is meant for hedging, speculation, and arbitrage. That we are going to discuss in detail. Okay. Having said this, this is the part. Now moving on to our main aspect, that is, now what is the emerging role? How basically the change in technology has brought changes into the market. Okay, as I discussed that traditionally we are expected to do the job roles of accounting, being a banker, being an auditor. So these were the earlier roles. But now the emerging roles have been changed. There are so many roles, but I have listed some of them in order to just make you understand. One could be either you can be into the investment banking. Okay, you can be into the equity research. You can be an asset or portfolio analyst. Okay, or you can be a risk analyst, corporate finance analyst, treasury analyst, financial data analysis, and quantitative analyst. There are so many roles. These are some of the ones. Out of this, the highest paid job is quantitative analyst. Now, what we will do is we'll try to understand what are these roles. Okay, what are the criterias? Okay, why and which are the top recruiting companies? Okay, where you will find that these companies are recruiting. Accordingly, you can prepare yourself and trying to get into this. Okay, so now the first job is investment banking analyst. So what is investment banking analyst, or what it does? Just imagine a company wants to list their share in the stock market. Are they going to do it independently? No. They hire the investment banker. Now, what is the role of investment banker? So, role of investment banker is that they have to value the company, get the valuation done. Okay, find out what should be the offer price. Okay, they will decide what should be the channel through which they can sell. So basically, they are acting as very good, Nikhil, acting as a bridge between a company and basically, if I have to list it on the stock market, so they act as a bridge wherein they do entire thing on behalf of the company. Okay, so raising capital, say bringing the IPO, initial public offerings kind of thing. Suppose if you want to get if you want to buy a company, it's acquisition kind of thing. So now the valuation of the company doesn't depend upon only the physical assets. Let me give an example. Suppose if you manufacture a car, okay, and the cost of car is suppose 5 lakh rupees. Okay, overall cost of car is 5 lakh rupees. Do one thing. Just do one thing. On that 5 lakh rupees car, just put the Tata company's logo. It might be possible because of this brand, say loyalty or the image in the market. The same car can be sold into market at say 7 lakh rupees per piece per car. Replace the Tata company's logo and just replace it with Mercedes Benz. The same car which has costed you around 5 lakh rupees will now sold into the market at 10 lakh rupees or maybe 20 lakh rupees. Now, is there any change in the say asset pricing? No. The change in price is because of the intangible valuation and the intangible value of that brand into the market. So now, when it comes to the mergers and acquisition, the most critical part is how to decide the valuation of the company. So the investment banker does that for you. So basically into the business valuation. Okay. Now let me give one more example. Suppose if you want to start a business. Okay, you generally you all must have seen the Shark Tank India, right? Suppose if you want to start your EV charging station. Now, how do you convince the investors that you are going to sell 5% of your equity at 20 lakh rupees? That 20 lakh rupees cannot be got from the year. We need to do the certain calculations, right? So these calculations might be in the form of, let's say, how many cars are going by that road where you are setting the charging station. What will be my profits at the end of the first year, second year, third year? So all these things can be done with the help of, say, valuation, business valuation. And all these things are done by the investment bank. Okay. So naturally, when I asked the same question earlier, so most of the students has given the answer that they want to get into the investment bank. So which are the top-notch companies which are recruiting there, the investment bankers? So Goldman Sachs, yes, obviously. JP Morgan, McKinsey, Morgan Stanley, Bank of America, Barclays, BNY Mellon, Capgemini are the examples of top recruiters. Now, what skills are required if you want to get into this? So apart from your regular academics, okay, naturally, if you want to get into the Goldman Sachs, they will seek that you should have a strong academics background. At the same time, as you will be in the part of the valuation team, they're expecting you to have a true knowledge about the accounting. When I say accounting, remember, I don't want you to prepare the accounting statements manually. You should be able to understand what are the elements of accounting. So when I say accounting, so it basically talks about three statements. One, income statement. Second is the balance sheet. And third is the cash flow statement. You should be able to understand each and every element, their purpose. That is accounting. Then valuation. So in valuation, basically there are techniques of forecasting. So these techniques can be discussed here. Then financial modeling. Yes, financial modeling, as I discussed, like say if you want to find out the let me give an example. Suppose if there is a solar panel company, okay, and that solar panel company, manufacturing company wants to set up a plant in one of the say state. I will give you a practical example. There is a company, Infisol Energy, in our city. Okay, so they want to decide, like say, they have an opportunity to set up a solar manufacturing plant in one of the reputed company in Sambhajinagar. Now, for the company, there are two models to it. One is called as a capex model. Another is called as an opex model. Capex model is, suppose why the company wants to set up the solar plant there. The reason being is they want to reduce the electricity cost. At the same time, they don't want to more depend on the state electricity boards. Okay, so capex model can be the company can invest their own money, set up the assets, and they can get the benefit. Opex model can be they can get into contract with the solar manufacturing companies for a longer duration, say for 25 years, and they will promise that for next 25 years they are going to buy the electricity for them only at a fixed price. So fixed price can be, say for example, for the time being, MSCB is charging us 10 rupees per unit. So I'm going to get at 8 rupees per unit. So immediately the company is reducing the cost by 2 rupees. That is called an OPEX model. But for the company which is setting the solar manufacturing plant, they have to decide, let's say, how much cost is required in order to set up the plant. And if they are giving electricity to the company at 8 rupees per annum, so for next 25 years, how much they are going to earn? So that the cost should be recovered. At the same time, investors' expectation can be fulfilled. So that is called as an, in this case, this entire concept is called as a modeling. We're trying to visualize what is my business as present and what will be in future. So this knowledge you should have. So therefore, if you want to get into the investment banking, you should have the knowledge of, and this valuation is done with the help of all three statements. So therefore, you should have the knowledge of the financial modeling. And while doing the financial modeling, yes, AI tools are important. For example, Claude is largely used in calculations. But I will personally advise you, go with the Excel and Advanced Excel, because those are the foundations on which your models are built. Because nowadays, people are using AI, but confidently nobody can say that whatever answers which are given by the AI are absolutely correct. So that's why The skill set is the advanced Excel. You should have the knowledge of advanced Excel. Then equity research analyst. For example, suppose if you get an nowadays everybody is trading into the market. Okay, if you are working with one of the broker generally gives you the tips that you should buy this share at this point, or you should sell this share at this price. How they are coming to that price? So basically, there are certain equity research analysts out there which are working with the broking firms. So what they do is, now the company valuation depends upon two things. One is the present profitability and potential profit, that is future profitability. Based on present and future profitability, they calculate the intrinsic value or implied value that we are going to discuss in future lectures. Okay, they compare the intrinsic value based on the profitability with the market value. Now, the market value of any share is decided by multiple factors. It is not the profit is not the only factor which decides the price of the share. There can be multiple factors. Okay, say for example, if there is a good news in the market, naturally the prices goes up. You must have seen the prices of Parley has recently went very up because of the Melody thing kind of thing. So that prices of Melody or Parley has nothing to do with their profitability. So market price can be affected by multiple factors. But as an investor, when should I buy? So generally what I do is I will find out what is the present profitability of the company, how much profit that company is going to earn in future. Accordingly, I'll calculate the intrinsic value. I will compare that intrinsic value with the market value. Okay, say for example, for a particular share, the intrinsic value is 400. Now, present market price is 500 rupees. Now, ideally, here I should sell the shares because anyhow, their market value is not supported by the profit. So in future, that share is going to go down. But other way around could be, suppose its intrinsic value is 400, but currently that share is trading at 300 rupees. So now it is a buying opportunity. So here, this is the job of equity research analysis. What the equity research analysts do is, they do the industry and company analysis. We call it as the fundamental analysis. Basically, they try to find out the moats. Now remember, the numbers need to support it with the moats. So what is moat, by the way? Just imagine that you must have seen most of the castles or the forts. Okay, earlier, the king used to dig a tunnel around the fort. What was the purpose? The purpose is that tunnel used to help us to protect from the enemy attacks. So those are called as moats. For example, so now when you talk about the children's, when there are newborn children's, if we have to feed something to the newborn children, so naturally there is only one company and which sells the milk products. Okay, now that company has the monopoly over the market. Okay, now for them, why they are able to create the monopoly? Because as per the licensing agreement, that company has got the license earlier. Okay, now the government don't want more companies to get into that food sector. Reason being is the government don't want to promote that mother's child cannot be replaced with the artificial, mother's milk cannot be replaced with the artificial milk. So that's why new licenses are not given by the company, given by the government. Okay, so the company which has already got the license has created the monopoly. So that can be the moat. Now it is supported by the increase in numbers. So every year they are earning the profits. So in this case, I'm sure that if the company's reputation is that much, that they have the moat means protection, that they are not going to immediately face the competition. Why? Okay, at the same time, they have the good profitability, I'm going to invest in that. Okay, so this can be found out with the help of industry or company analysis, financial statement analysis, and valuation and research of this. Okay, so here responsibilities are like this, like industry and company analysis we have to do the financial statement analysis, and valuation and research reports are need to be prepared. So this is the job of equity research analysis. Now the companies largely which recruit the equity research analysis are Bloomberg, mutual funds, brokerage firms, and asset managers. Now what skills are required? So in this case, if you want to get into this, you should have the good knowledge about accounting, valuation, financial modeling, Excel. Yes, AI is needed. Okay, but at the same time, you should have the knowledge about, you should have the certification, minimum certification of CFA 1 and NISM's research analysis certificate. Rather, I will advise 3 certificates. 1, introduction to financial market. Second is the research analysis, and third is the financial derivative. If you have these 3 certifications, you're more suitable for equity research analyst job. Next is asset management and risk management or risk analyst. So asset management is typically these jobs are available with asset management companies. You must be knowing that India, one of the world's largest asset management company is the BlackRock. Okay, which they basically they are the biggest asset management companies in the world, and they are funding even the U.S. government. Then Franklin Templeton, wealth management firms. All these people are required for asset management. So basically, they are working on a portfolio management concept. So here your job is portfolio construction, asset allocation, and risk management. Okay. Skills required is here, apart from the regular skills, you should have the knowledge about the portfolio theories, then capital assets pricing model, and preferred certification would be CFA. If you have CFA, you will get the better chance to work with the AIMs. The risk analyst. So largely there are different types of risk are there: market risk, credit risk, liquidity risk, or operational risk. Market risk, the risk which is associated with the market. Credit risk, that is the possibility that the other person is not going to repay us back. Liquidity, just imagine take an example of the real estate company. They invested heavily in the fixed assets. Now they are unable to pay laborers to the laborers for constructing the building. So this is a liquidity risk. Operational risk are the internal risk. So as a company, if there is a company, okay, every company wants to mitigate the risk. For that purpose, the big companies generally recruits risk analyst. So for risk analyst, you should have the skill sets. For example, statistics. You should know what is VAR, value at risk. You should know the language Python. Nevertheless, if you know the Google Colab, the Python language, even if you don't know, it's okay. SQL, and you should have the knowledge of Excel. So this is the job profile for risk analyst. Next is corporate finance and treasury. So corporate finance, in the sense, even nowadays, big companies are hiring the finance people for budgeting, forecasting, and capital. And for example, budgeting means even the company has to manage. Let's say find out how to procure the money, how to use it. Okay, even they need the money. Suppose if they want to acquire a company, okay, they want to find out, let's say, how much money that plant is going to generate in future. So that is what the forecasting is. So for internal finances, okay, they hire the people that called as a corporate finance analyst. Nowadays, it is also you are getting a big opportunities in this sector, so you can be in that. Treasury analyst. So specifically, if you get into the bank and if you are working in the treasury department, you are exposed with a lot of cash. So in that case, a typical role would be cash management, then hedging, and at the same time ensuring sufficient liquidity so that if any untoward incidents comes in, you should be able to mitigate that. Okay. And large recruiters, for example, in this case are large corporations, MNCs, and banks are required. Then next job is about financial data analysis. Okay, now guys, just remember, we'll take an example of, so there are so many agencies are there which are rating either companies or even the countries. Okay, for example, S&P, Moody's rating. So these ratings are basically depending upon the multiple data factors. Okay, the safest rating is suppose AAA. Safest rating is AAA. So it means that is the safe environment where we can invest with a blind eye. Okay, but how do you decide that which country or the company should be given the AAA rating? So this AAA rating is given based on a different sets of data and a huge data. And that is the area where a job of financial data analysis comes. What is the job of data analyst? So in this case, the financial data analysis has to deal with the massive data. Okay, they have to just collect the data, clean the data, and then they have to come up with some actionable insights. Let me give an example. Suppose you are working in one of the company called as a Meta. Meta has two products, Facebook as well as Instagrams. Okay, so if they have to sell something, okay, if they have to suppose every day, you will find that people's behaviors are different. There are so many people who are using Meta and they are having, say, different choices or the habits of clicking on the different, advertisements kind of. Now, depending upon their preferences, that data is collected and accordingly, the similar ads are shown to the person or similar products are pitched to the people. Now, how they have come to know, so these kind of products are only shown to this person because this is done with the help of data analysis. They collect the data, we call it as the big data, they clean it, and they try to get the actionable insights. So this can be done with the help of financial data analysis. So here, it is also one of the big role which is coming nowadays. Okay, So for that purpose, your job requirement would be like, so you should be responsible for data cleaning, dashboard development, predictive analytics. Predictive means what is going to happen in future, and then financial forecasting. The tools which are required for financial data analysis: Excel, SQL, Power BI, and Python. The biggest recruiters for this are Bloomberg, S&P Global, Moody's, FinTech firms. Last is quantitative analyst. So as I told you, it is one of the highest paid job in finance profession. It basically combines all skills. But in order to be a quantitative analyst, you should have a strong knowledge of mathematics, statistics, and programming. Your core disciplines where you work is finance, mathematics, statistics, and programming. This includes your responsibilities include trading models. So what is trading model? There is a concept called as a algorithmic trade. So what is algorithmic trading? Suppose an active trader is the one who sits in front of the screen, try to find out the trend in the market, and accordingly decide whether to buy or sell. But just imagine, with the help of AI, what I did is that I know the technical analysis. So there are two types of analysis are there: fundamental analysis and technical analysis. In technical analysis, I mastered Heikin-Ashi chart. Now, if you see the either say candlestick chart, Heikin-Ashi chart. So if I see the Heikin-Ashi chart, then there are certain patterns where I can, looking at those patterns, find out when to buy the share or when to sell the share. Okay. Now, suppose if I fade those patterns to the AI, okay. Now, instead of actively monitoring the market, whenever that trigger points comes, that AI is going to say either buy the shares or sell the shares on my behalf. Okay. But in order to deal with those patterns, I need to deal with the multiple aspects. One, I need to know the mathematics, logics behind that. Okay. I need to create the models, right? So in this case, a quantitative analyst job is comes as a handy one, where a lot of automation can be done. Okay. So basically here you are able to create the trade models. You are able to mitigate the risk models. For example, suppose if I have say I want to buy a share. I generally when we buy the shares, risky shares, we generally keep the stop losses. So what is the stop loss? Stop loss is basically I want to find out that beyond that point, if the company's share goes down, I don't want to take the losses. So then how do you find out what should be that label? So that label is decided with the help of risk models. Then forecasting models can be done with the help of quantitative analysis. Then the skills which are required are, as I told you, it requires all four skills: mathematics, statistics, programming, and finance. So you should have the knowledge of Python, R, C++, probability, and statistics. The top recruiters are Jane Still, Tower Research Capital, hedge funds, algorithmic trading funds. So these are some of the companies where you will find that quantitative analysis are recruited. Okay. So guys, there are so many rules. I don't think, given the considering the paucity of time, we are going to cover everything. But particularly, if you have any questions, please let me know. We will discuss that. I hope you are able to clear it. You will understand this, okay? Yes, Aditya. But I have heard basically people from IITs. Aditya, can you please ask your question, because I'm unable to read it. Okay, just please. IITs Levy get this job. No, Aditya, this is myth. The reason being is you won't believe that there is a one student of mine who is from the Chhatrapati Sambhajinagar. She is presently working with the Goldman Sachs. It is not at all required that only the people of IITs are able to crack these interviews. Okay. Only thing is you should have what are the job roles, and accordingly you need to do a little bit extra. For example, you cannot solely rely on your academics. Apart from the academics, you need to go with the multiple certification courses. Okay, you need to acquire the additional qualification. For example, if you have the CFA is much more preferred over the MBA Finance or MBA Finance or MSc Finance. Okay, so city or location has nothing to do with the jobs. Okay, yes, Aditi. For quantitative analysis, can MBA MSc Finance student apply for? Yes, you can. But the thing is, the only aspect is in your graduation or in the 12th, you should have the mathematics. And if you're good with the mathematics, you don't have an issue. They don't have an issue.
Sir, I'm audible.
Yes, you are audible. Yes, sir.
So basically, I did my BBA. I had maths in my 11th and 12th, and then after it was my BBA was majorly it was like an integrated programming management. So we also had maths and stats in undergrad. Then there was this course of outside called PG Diploma in Statistics and Analytics. So I did that course for 1 year. So we basically had these subjects of time series regression and everything. But the the kind of math required for this role of quantitative analyst is like they want students who have studied statistics or maths in their undergrad. So I'm
Okay.
not sure if we can get into this role of quantitative analyst. Could you please tell more about that?
Okay, okay. Aditya, as such, okay. Say the requirement is you should have mathematics either in your graduation or 12th. Specifically, what you learned, they're not bothered about. But at the same time, it is the demand for that rule that you should be well versed with all statistical concepts. So even though you don't have that engineering background as of now, but if you have an interest in mathematics, okay, you are able to learn the things. For example, trend analysis is normally used. Probability, you should be good with that. Even if you don't know the derivative and integration, sometimes it is okay. But if you know the statistical part, particularly correlation, regression, okay, then probability, okay, trend analysis. So these are the concepts which are widely used in logical. So if you are time series analysis, yes. So if you are good at that, so you are easily able to crack the interviews. There is no as a specific requirement that in mathematics what exactly your the curriculum should be. So you're okay with that, don't worry, because you have BBA, PGDBM in statistics, and if you are good with the numbers, you can go with that, no problem, and you are eligible, no problem. Okay, anyone else, guys? Any other questions?
And sir, also could you tell more about product management in finance?
Product management. Okay. Now remember, largely product management is in insurance sector. We call it as actuaries. Okay. So when insurance companies design their products, naturally, even though it seems lucrative to the customers, okay, there is certain mathematics behind it. No company wants to suppose just imagine कि आपने कोई product बना दिया and that product is say helping the customers in a big way. But suppose अगर insurance company सब पैसा दे रही है, they will be at losses. Okay, their job is they want to collect more premium and they want to give the less refunds to the customers. Okay, so there should be some calculations. So in that case, largely the product development is done in insurance companies. But yes, in that too, we should have the knowledge of both finance, but you should be statistically strong. So if you are good with the numbers, then you will get that job there. Okay, before starting MBA, MSc Finance, what skills which are bare minimum must know? Okay, so Aditya, very good question basically. So if you want to get into say MSc Finance, okay, I'm not talking about MBA or MMS kind of thing there. Even so you are using AI that will help you in a big way. Okay, but you should have the clarity about the statistics. Okay, so before going for say MSc Finance kind of thing, so 2-3 things I specifically want to list out. One, if you're comfortable with the numbers, okay, and you are even though you have the lesser background earlier, okay, so you can get into that, no problem. We can easily cope with that. But if you are not comfortable with the numbers and even you are struggling for the basic calculations, my advice is don't go for that. Number one. Number two. So if you want to get in there, then what skill apart from your regular academics, okay, you should have the extra qualifications. So what qualifications are required? For example, in Aditi's case, she has done PGDBM in statistics. Okay, now you must be in your graduations. In your graduation, if you have mathematics as a subject, no problem. If you don't have it, acquire one. That is the second thing. Third, so if you want to get into the finance field, one of the area where you will find that be it investment analysis, okay, be it say equity research kind of thing, you will be exposed to financial market. Okay, so for NISM, try to do at least 3 certification courses of NISM. One is Introduction to Financial Market, second is the equity research, and third is the financial derivatives. This will help you in a big way. And if possible, try to get at least CFA level 1. If you have these skills, mark my word, if you are getting into MSc Finance, okay, you will be, get a good job in that in future.
Hello, sir.
Yes, Ajit. Yes, please.
Sir, I was thinking of starting preparing for CFA level 1, but I think like 1 month or so is remaining for my college to start, and I don't think I'll be able to study for it and cope up with my MBA curriculars. And it's like, I don't think it will be so. So, what would be the right time for me to start for CFA? Ideal time, like after MBA or
Okay.
what?
Okay. Aditya, to be honest with you, I am in the academics from last 17 years.
Yes.
Okay. So you can take example of any MBA institute that. Okay. Can you please mute yourself, Aditya, because there is an echo. Huh. So Aditya, sorry. So actually, now take example of any MBA institute. Okay. Their curriculum is not that much extensive okay, where you need to work for say 10 hours, 12 hours kind of thing. Largely, MBA में होता क्या है? Apart from your regular academics, extra activities are given to build your communication, personality kind. Outbound activities ज़्यादा होता है. But when it comes to the core teaching होता है ना, वो बहुत कम होता है. So you can easily cope up with that, even if you're starting today. मतलब होता क्या है? जितना आप late करोगे, उतना it will be difficult for you to get complete the certifications. तो अभी भी time नहीं गया. Even you're starting today, that is the right time to start.
Okay, sir. Thank you.
Okay. Anyone else, guys? Any questions? Okay, guys. If you don't have any questions, so thank you so much, everyone. It was nice to interact with you. With this, I think we need to close the session. So thank you so much. Have a nice day. We'll see you in the next class. Okay. Thank you. I hope you enjoy the session.